It's Finance Friday, another special bonus edition of Money Girl. This is where I answer your money questions. And today, it comes from Adam. He says, I know that the One Big Beautiful Bill, or OBBB, that recently became law is really big. On an upcoming show, I'd love to hear highlights about changes that are coming for average Americans. Can you explain in simple terms how taxes for a typical individual or family will change, and tips to make the most of the OBBB? Well, I have to tell you, I had to prioritize this question because it came from my husband. We started talking about the new law, and he asked me to summarize the key tax changes. Since the volume of tax revisions makes it pretty challenging to list quickly, and I certainly couldn't do it off the top of my head, I told him that I'd do some research and share it as a bonus podcast. So here it is. This podcast will review 8 tax changes in the OBBB most likely to affect your finances. You'll learn what's changing, who it helps, and what you can do to prepare for upcoming tax law changes. Welcome back, everybody. This is episode 945 of Money Girl. I really appreciate you downloading the show and spending time with me. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. And I want to invite you to my next live event. It's happening very soon. So please register now for my Smart Investing Masterclass. It's called How to Make Money and Achieve Financial Freedom While You Sleep. You'll get an hour of live instruction and up to 30 minutes of Q&A. Everybody who registers will get the video replay, even if you can't attend the live class. You can register now by clicking the link in the show description or by signing up for The Money Stack at lauradadams.com. Your welcome email will include registration options. And if you're already a member of the newsletter, fantastic. You're going to get more information about the live event until the day that it actually goes live. So I can't wait to see you and take your questions either ahead of time or live in the next masterclass. All right, so let's talk about this One Big Beautiful Bill. You've probably seen a lot in the news lately about this bill becoming a law on July 4th of this year, 2025. It is the most significant overhaul of the United States tax code since the Tax Cuts and Jobs Act of 2017. Now, some changes begin right away, but others won't take effect until January 1st, 2026. So even though taxes aren't the most exciting personal finance topic, I do want to make sure that, you understand what's happening and you get the most from the new provisions, which can be complicated. And as I said, some of them are going to take effect right away. Some of the new law's changes make provisions from the Tax Cuts and Jobs Act permanent, like our current tax rates. Otherwise, they were going to expire, taking our tax rates back to pre-2017 levels. And as I mentioned, this podcast won't be a complete list of tax changes in the One Big Beautiful Bill, but I'm going to cover 8 of the most significant revisions that I think you should know. So let's get into them. Number 1 is an increased SALT deduction. Now, a tax deduction is a predetermined amount that reduces your taxable income, and that reduces the amount of tax you owe. So the SALT deduction stands for state and local taxes. And this deduction has been around, but it's been a hot topic because many people pay very high amounts of state and local taxes. So the deduction was previously capped at $10,000. A lot of people thought that was way too low. But now, thanks to the OBBB, it is going to increase. The cap will now be up to $40,000. However, the adjustment is going to be made gradually. It's going to increase slowly from 2025 through 2030. So that's really good news for taxpayers living in high tax states and those with more expensive homes that are likely paying very high property taxes. However, once your modified adjusted gross income exceeds $500,000, the deduction phases out for you. So only those earning less than $500,000 can claim the full deduction if they pay as much in state and local taxes. So for instance, if you pay $50,000 in state and local taxes, you could get that $40,000 deduction because that's the cap. All right, the second thing that's changing are higher standard deductions. So another helpful tax deduction that we all get is the standard deduction. This reduces your taxable income based on various qualifications like your tax filing status, your age, and even your health status. For 2025, the standard deductions will increase as follows. They're going to go from $15,000 to $15,750 for individuals. They're going from $22,500 to $23,625 for those who claim as head of household, and they're going from $30,000 to $31,500 for married couples filing joint taxes. Now, in addition to this, individuals over 65 can claim a little bit more. So they can claim an extra $2,000 or even $4,000 if they're also blind. Those over 65 filing joint taxes can claim an additional $1,600 or an additional $3,200 if they're also blind. Now, on top of that extra deduction for those over 65, the One Big Beautiful Bill gives those seniors a bonus deduction of $6,000 for tax years 2025 through 2028. But it only applies when you earn less than an annual income limit. So the deduction gets phased out when your modified adjusted gross income exceeds $75,000 as an individual who's over 65 or $150,000 as a couple filing taxes jointly. Again, this is only for those over 65. So this bill is really trying to favor seniors by kind of stacking on the deductions for them. And I do want to mention that, speaking of seniors, a confusing email came out from the Social Security Administration. I got one. You all may have gotten it. It went out to 60 million people. And it was confusing because it stated that the One Big Beautiful Bill eliminates federal income taxes on benefits for nearly 90% of Social Security beneficiaries. Now, this email made me do a double take because while the new law is beneficial for some seniors, it doesn't change taxes on Social Security benefits directly or permanently. I want you to note that up to 85% of Social Security retirement income can be subject to tax based on an IRS formula that calculates a retiree's provisional income. So, you add up a bunch of different things, and based on that number, the tax is based. So that tax still exists. But there's no denying that the bonus deduction, the $6,000 bonus deduction, will be beneficial to those over 65 with middle to low incomes. All right, the third tax change in the One Big Beautiful Bill is a tax-deferred account for children. So the OBBB allows parents to open a tax-deferred savings account for children under age 8. If you do that, the federal government will make a one-time contribution of $1,000 if you open the account for a child born from 2025 through 2028. And the Department of the Treasury will oversee these accounts, and you can open one as early as January 1st, 2026. And you can contribute up to $5,000 a year until the child reaches 18. Now, distributions from the account can be used for qualified expenses only. So these might be things like education, starting a business, or even buying a home. If you use the funds for these qualified purposes, they get taxed at long-term capital gains rates. So that's really different because those rates are more favorable than ordinary income tax rates. However, any non-qualified distributions would be subject to ordinary income taxes plus a 10% penalty. So what's interesting is that after age 18, an account holder can tap 50% of that account balance for a qualified expense. So again, it could be something like going to school. And once they reach age 25, they can tap the fund in full for any qualified expense. But after the account holder reaches age 30, they can use those funds for any reason. So really interesting account. And, I think it is an excellent way to kickstart savings for young kids. I mean, that $1,000 can grow significantly and really encourage families to contribute even more. So everyone who has a child through 2028 should take advantage of this new account. Again, you can open them as early as January 1st, 2026. The fourth change from the new law is no taxes on some tip income. Starting in 2025 and going through 2028, the new law includes a tax deduction for up to $25,000 in tip income. However, it does phase out when you have a modified adjusted gross income over $150,000 as a single taxpayer or $300,000 as a married couple filing taxes jointly. And the fifth benefit is no taxes on some overtime pay. So again, starting in 25 and going through 2028, the new law includes a deduction of $12,500 for overtime pay as a single or double $25,000 as a married couple filing taxes jointly. Just as with the tip income exclusion, this deduction also phases out when you have a modified adjusted gross income over $150,000 as a single taxpayer or over $300,000 as a joint tax filer. The sixth change is no taxes on some auto loan interest. So from 2025 through 2028, you can deduct up to $10,000 of interest paid on a car loan, even if you don't itemize deductions. So this one is, works a little differently. Some of the deductions you have to itemize, but with this one you don't. But it does phase out when you have a modified adjusted gross income over $100,000 as a single taxpayer or $200,000 as a married joint filer. So due to the relatively low income thresholds, it's going to benefit those with middle to low incomes. All right, the seventh benefit is a bigger child tax credit. A tax credit is very different from a tax deduction. A credit is a direct reduction in the amount of tax you owe, whereas a deduction is going to apply to your taxable income. And so the new law permanently increases an existing child tax credit from $2,000 to $2,200 per child starting in 2025. So it will get adjusted for inflation annually. And while this is a small credit increase, it will be valuable to families with children under age 17 with middle and low incomes. And number 8, the law is providing a higher estate tax exemption. So the estate tax is a tax on the property that transfers to others after your death, including everything you own of value. It could be cash, securities, real estate, trusts, annuities, business interests, etc. And the new law makes a previously temporary estate tax exemption of $15 million for individuals and $30 million for married couples a permanent rule. It will also include an annual inflation adjustment. So obviously, this only affects those with an extremely high net worth. So to sum up, the massive One Big Beautiful Bill makes many tax cuts and reforms of the Tax Cuts and Jobs Act permanent. It introduces a few new tax breaks that will offer some help to those earning middle and low incomes. The provisions for no tax on tips, overtime, and auto loan interest do come with conditions that the IRS has yet to interpret. So the law may add some layers of complexity to the tax code instead of simplifying it, which I never like. But those earning high incomes or having a high net worth are likely to benefit the most from provisions like the SALT deduction and that very high estate tax exemption. So I hope this has been helpful and maybe will get you thinking about some things that may apply to you in your tax situation starting this year. And before we go, a quick reminder to subscribe to The Money Stack when you visit lauradadams.com. And I hope to see you in my next live event. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team I want to thank. Steve Rickyberg audio engineers the show. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. And Nathaniel Hoops is our marketing contractor.